names, tighten it to ROA over 25%, and maybe you're down to just 7. Lets you focus your deep research time where it counts.
But the big warning is you have to understand the ratios you're using.
Absolutely crucial. If you just plug in numbers without knowing what they mean or their limits, you might screen out good companies or fail to adjust for market conditions.
You need context. Does this PE make sense for this industry right now?
Exactly. That contextual intelligence is key. But the great thing is, because fundamental analysis uses public info filings, statements anyone can learn to do analysis comparable to the pros. The data is out there. It's about smart interpretation. 3. Navigating the minefield. Common pitfalls and challenges. Even with the best tools, value investing has its dangers. Maybe the sneakiest is the value trap.
Ah, yes, the siren song of cheapness. Looks good on paper, but
it's actually not cheap at all. These stocks look statistically inexpensive, maybe a big discount to net asset value, NAV, but there's a hidden problem.
What kind of problem?
Often, their balance sheets are weak on liquid working capital,
Yeah.
but loaded with illiquid stuff, old factories, useless land. The issue is, you can't see how the value gap will ever close. How will they actually turn those assets into cash?
It's just dead weight on the books.
Pretty much. And meanwhile, the company might keep losing money, so that margin of safety you thought you had just evaporates. Selling those fixed assets can take forever, hit roadblocks. It's often a dead end.
So it's not just about the discount, it's about the path to realizing that value.
Exactly. Tweedy Brown found that a discount to working capital was a much better indicator than just a discount to total assets, because working capital is more readily usable.
Good tip. Okay, another huge hurdle, us, our own emotions and
The
biases.
human element.
Yeah.
Massive challenge. Think about market manias, bubbles, prices soaring. Everyone feels like a genius.
False confidence kicks in.
Dangerously so.
Right.
People start taking huge risks, leveraging up, thinking it'll never end. Disaster waiting to happen.
Like Bill Ackman and Valiant. Even smart guys get caught up.
Absolutely. Blinded by nice-looking financials, maybe ignoring fundamental business or ethical risks, got swept up in this story. Then there's Mohnish Pabraya's term, cocaine brain.
Huh? Explain that one.
It's how the sheer excitement of potentially making money can hijack your rational brain like a drug. You start ignoring red flags, especially with complex or leveraged companies. Robert Shiller talks about crowd mentality driving bubbles and crashes too. We stop thinking for ourselves.
And Charlie Munger's extra vivid evidence. How does that trip us up?
It's when something really striking, really vivid, like seeing a stock go vertical on TV, hearing stories of quick riches, overrides our rational analysis.
The reptilian brain takes over.
Kind of. You react emotionally, irrationally. Makes it super hard to see that the price is totally detached from reality. Leads to that herd behavior, buying high, selling low. It's hardwired, makes staying disciplined tough when everyone else is freaking out or you